So if we wanted to move on to cash flows, so the cash flow of the company, the idea behind the cash flow statement, this is a relatively new statement. It's only been around for, say, whatever, 30 to 40 years, thereabouts. So the cash flow statement is, the idea is it's supposed to give us the cash flows of the company, with the idea that we have accrual accounting, and there's cash basis accounting, which we generally don't think of as doing as good a job of presenting the financial position or condition or performance of the company, but it does provide some information. So the introduction of the cash flow statement is presenting that information to investors so that they have the accrual accounting and they have the cash flows, and they can use those two pieces of information to get a fuller picture of the performance and the condition of the company. So that's how we ended up with a cash flow statement. And the cash flow statement is broken into three categories. So there's three categories. We have operating activities. The operating activities portion of the cash flow statement is supposed to represent the cash equivalent of net income. That's why when we actually do an indirect cash flow, we start with net income and we adjust it to get to cash flows from operations. And it's basically a reconciliation between net income and cash from operations, with the idea that if we presented the income statement on a cash basis, this is what we would get for cash inflow from operating activities. So that's the operating activities section. We then have investing activities. Investing activities represent both internal and external investments. So investments are things that the company expects to earn some return over a longer period of time. For instance, if they buy the stock or bonds of another company as an investment, that's expected to generate cash in the future, hopefully more cash than they put in. That's why it's an investment. Similarly, if they buy an asset, let's say they buy a new manufacturing facility, that is an investing activity. It's an internal investing activity because they expect the cash generated by that new facility to exceed the purchase price. So that is an investing activity, internal investing activity. Both internal and external investing activities get reported in the investing activities section of the cash flow statement. The financing activities is the last section. So financing activities are, how does the company finance its operations? That's generally debt and equity transactions. That includes issuing stock, paying dividends, issuing long-term bonds. Those are all ways the company is financing its operations. Those end up in the financing section on the cash flow statement. So the cash flow statement, generally there's four steps to preparing it. First, we do determine the net cash provided or used in operating activities. This is usually the most complex and the most difficult area. So we, again, as I mentioned before, it's essentially a reconciliation between net income and cash flow provided by operating activities, where we take net income and we adjust it for basic accrual accounting stuff. For instance, depreciation expense is an expense on the in net income, but it's not cash flow. So we need to take depreciation out of net income, or add it back into net income to get closer to cash flow provided by operating activities. So that would be depreciation. Gains and losses are also non-cash. The gain or loss itself is non-cash. Now, you generate a gain or loss by usually selling some investment. Now, selling an investment is usually a cash inflow. If I sell a building or sell a car that we've been using in the business, that is going to be a cash inflow because I theoretically, hopefully sold it for money. That is a cash inflow. So that cash inflow goes on investing activities, but the gain or loss, all that is the difference between the sale price and the purchase price, or the basis in the asset and what we sell it for. The gain or loss itself is not cash flow. So if we report a gain on the income statement, so there's a gain sitting in net income, that is a non-cash gain and needs to get taken out of net income to get to cash flow provided by operating activities. Similarly, if we report a loss that's sitting in net income, it's a non-cash loss. So we would add that back to net income to get to cash flow provided by operating activities. So those are kind of non-cash items that just need to get pulled out of our calculation to get us to cash flow provided operating activities. So we do that by adding back depreciation, adding back losses, and subtracting out gains. Now, there are other accrual items that end up in net income, for instance, that we usually do or take into account by looking at essentially all the current assets and current liabilities, and we look at changes in those. And the rationale behind that is, so if we have, let's say, accounts receivable. So if accounts receivable goes up, well, accounts receivable goes up because we make a bunch of sales but don't collect cash. Okay, well, if we make a bunch of sales but don't collect cash, then our cash sales for the period are actually lower than our accrual basis sales. So if accounts receivable goes up, then the cash goes down, because so we need to reduce net income from what's reported to get to cash flows from operations, because the receivables represent sales that have not been collected yet. So if receivables goes up for the period, that means we made more sales than we collected in cash. So that we need to reduce net income to get to cash flow from operations. Inventory is the same way. So basically all of our current assets, if they go up, that represents a reduction in net income to get to cash flow from operations. So that is a decrease. And the opposite is the case for current liabilities. So if my accounts payable goes up, for instance, well, accounts payable goes up because I incurred expenses that I didn't pay for in cash, so I still owe them. Well, if I incurred expenses but I didn't pay for them in cash, well then the fact that the liability went up means my cash went up in relation to net income. So an increase in accounts payable represents an increase in cash, because that's expenses I have incurred but have not yet paid in cash. So they would get added back to net income to get me to cash flow from operations. So those are some of the more complex items within preparing a cash flow statement. Make sure you're familiar and comfortable with that. If you need to, go back through. I worked through a very detailed example in the lecture, as well as when we met as a class. So go back through those, look at them, make sure you can do those type of calculations. So that's cash flow provided by operating activities. Next, we go to cash flow from investing activities. As I mentioned before, investing activities represent internal and external investments. It's just the cash associated with those. If we bought a piece of equipment, that represents a cash in or cash outflow because we bought the piece of equipment. If we sell a piece of equipment or we sell an investment, that represents a cash inflow associated with how much we actually sold the piece of equipment or the investment for. The last item we deal with is financing activities. So financing activities are equity and debt transactions, or primarily long-term debt transactions. So if we issue more equity, we issue long-term bonds, that would be a cash inflow. If we retire equity or a bond matures and we pay it off, that's a cash decrease from financing activities. Dividends go into financing activities. Now, once we have cash flow from operating activities, investing activities, and financing activities, then we need to determine the change or the increase or decrease in cash during the period. That should be what we've just calculated between those three areas. And then we reconcile that to the change in cash from last year. It should reconcile. If it doesn't, then we made a mistake and our cash flow doesn't balance. So that's the last step, is reconciling the change in cash as calculated on the cash flow statement to the change in cash shown on the balance sheet between the two period beginning and ending cash balances. So that pretty much wraps up the balance sheet cash flow statement. The last thing we're going to deal with is time value of money. So the time value of money, this should not be a new concept to the most people who are watching this video. You should have seen this in the past and prior classes. The time value of money, the relationship between time and money. This idea that $1 today is worth more than $1 in the future, with the notion that, okay, if you were to give me $1 today, that is worth $1. I would gladly trade you $1 for $1 today. If we meet each other, you have $1, I have $1, we trade them. That seems like a fair exchange. However, if you're saying, okay, well, I'll give you $1 next year. Well, I'm not going to give you $1 today just to get $1 next year. That doesn't make any sense. I would rather have my dollar than you have my dollar for the next year. So if you want to give me $1 in the future, I'm not going to give you the full dollar today. I'm going to give you something less than that, which means that that dollar in the future is actually worth less than the dollar today. So that is this basic idea of time value of money concept. Now that does imply a positive interest rate, which is true. I would argue, I'm not an economist. This is not my area. I'm a very simple accounting person. So I would argue it is not possible to have negative interest rates. Now, you can make it look like there's a negative interest rate. If you're a government and you want to actually institute a negative interest rate and force people to do it, or force people to participate in your negative interest rate, well, then you can, because you're the government and you can force people to do all kinds of things because you have rule of law that you back up with jail time, guns, and everything else. So you can do whatever you want if you're a government. However, that doesn't mean that that's actually something that can occur. For instance, and my simple argument would be, anyone who wants to argue that you can have negative interest rates, I will gladly take this on. You can give me all of your money today, and next year you can pay me more for having your money today. I will enter into that transaction all day long. So the day someone's willing to give me that deal, I will admit that there are negative interest rates. Until then, I'm going to maintain there's no such thing as a negative interest rate, and $1 in the future is worth less to me than $1 today, which means if you want my money, if you want to use my money, or if I want to use your money, you're going to charge me something for the use of that money. You're not going to pay me to use your money. So that just kind of makes sense. Okay, so that's time value of money. Real quick, there are a lot of applications in accounting. Most of them are present value applications where we're taking some future series of cash flows and we're discounting it back to figure out, like, okay, well, what's the total value of that as of today? For instance, we use that for notes and leases, pension obligations, share-based compensation, business combinations, and disclosures and environmental liabilities all have present value-based measurements of some future cash flows that have to get reported in the financial statements. So this ends up coming up a lot. We'll walk through a bond example. I did it in the earlier lecture. I'll walk through it real quickly today without the numbers. I'll just talk through it. But this is something that comes up a lot, especially the present value measurements. Now, the basic concepts, we have three main variables. We have the principal, the interest rate, and the time. Principal is just the amount borrowed or lent. The interest, which is a rate, is a cost or a return on the money borrowed or lent. It's stated as an annual percentage of the outstanding principal balance. It is an annual percentage. Note that, unless it explicitly says otherwise, which it almost never will, the interest rate is always stated annually. And then the time is in the number of years. So it's assumed years, but it could say whatever, 6 months or something, but that's just half of a year. So if you want it, you need to equate the time piece to the interest rate. So we typically talk about both of them as a yearly numbers. So most interest is done in a business setting is compound interest, where the accumulated unpaid interest is actually earning interest itself. So you can have different compounding periods. You can compound daily, which means the interest that I accrued yesterday but have not yet paid, if I'm the borrower. So the interest that I accrued yesterday but I haven't yet paid because I don't have to pay my mortgage payment until the end of the month. Well, that's now accumulating interest itself. And then the next day I'm accumulating interest on the past 2 days accumulated interest. So interest is growing at a compounding rate. So I'm actually paying interest on the unpaid interest. So that's compounding. You can have different compounding periods. Banks always have compounded daily. Some other notes between companies or something may compound on a less frequent basis, just out of simplicity. May compound, say, monthly if there's a monthly payment, and that simplifies the calculations because then you can use your typical annuity calculations. So that is compounding. Now, the more compounding periods you have, the higher your effective rate is. There's the stated rate. That's the rate at which you're paying interest on. But if it's compounding daily, your effective rate is higher unless you pay the interest every single day, which generally doesn't happen. If you pay the interest every single day, your effective rate and the stated rate will be the same. But if you pay your bill monthly and interest is compounding daily, your effective rate will be higher, because every day it's kind of growing until you pay it off. And then again, it starts to grow until you pay it off. Now, so if you have a compounding rate of daily, your effective rate is going to be higher. If your compounding rate is 1 year, your effective rate and your stated rate are identical. So the more the loan compounds, or we'll just go with loan. The more the loan or principal compounds, the higher your effective rate is. And that's the difference between your stated rate and your effective rate. Okay, so let's see. We moved on from single sums. We talked about annuities. Annuities so single sum is just what's the present value of one big single sum in the future, or what's the future value of a single sum that I invest today, for instance. So that's single sum. We then dealt with annuities, which are periodic payments called rents. So periodic payment, which would means, let's say, oh, I'm going to invest $1,000 every month for the next 12 months. That's an annuity, right? So it's something that happens every month. So I have to have periodic payments or receipts for an annuity. The length of time has to be the same. In that case, it's 1 month. And the interest that compounds, it has to compound once each interval. So it has to compound monthly. Hence the difference between, say, what you would calculate for what a bank would calculate using daily compounding and what you would calculate using an annuity table or your annuity calculator. So that's an annuity. There are two types of annuities: ordinary annuity, where the payments occur at the end of every period, and an annuity due, where the payments occur at the beginning of every period. Based on the name, an ordinary annuity is the most common. And that is because normally if you're borrowing money, you're not going to make a payment on the same day you borrowed the money. You're going to make a payment at the end of the first period. So it's far more ordinary, and that occurs that is far more common, is to have an ordinary annuity. Now, once we introduced single sums and we introduced annuities, we then put them together and we walked through valuation of a long-term bond. So long-term bonds have both a single sum and an annuity component. So a long-term bond has a face amount of the bond, and that is the amount that will be paid at the maturity date of the bond. So if we have a $2 million bond that is 10 years, in 10 years, I am going to pay $2 million. That is a single sum. If I want the value of that, I just present value that single sum back to today. Now, that's the single sum portion of a bond. Also, the bond will be making a payment periodically. Let's say this bond pays, let's say it pays once a year. So this bond pays once a year at 7%. So that would be $140,000 once a year. So this bond pays $140,000. This $2 million bond pays $140,000 every year for the next 10 years. Well, that's an annuity payment. If I want to calculate the present value of that, I just discount that back to the present value of an annuity. This is an ordinary annuity. So if I want the value of the bond, I figure out the present value of the single sum maturity or face value of the bond, and I single sum, and then I calculate the present value of all the annuity payments, or what are called the interest payments of the bond, to the present value. Now, if this is a 7% bond it's paying 7% annually. If I, as an investor, want to buy this bond and I'm willing to accept 7%, I'm going to pay $2 million today for this bond. I'm not paying a premium, I'm not paying a discount, because my rate, or the market rate for this bond, is identical to the stated rate of the bond, or the payment rate of the bond. Now, that never happens because the market rate is always a little bit different than the stated rate on the bond. So because of that, we end up with premiums and discounts, which means when I discount back that single sum, or I discount back that series of interest payments, I'm not going to get the $2 million like I would if I was demanding 7%. Let's say I'm demanding 8%. So I, as an investor, look at this company and say, yeah, I'll loan you $2 million, but it's going to cost you 8%, not 7%, 8%. Well, if I'm demanding 8%, I'm not going to give them $2 million today. I would give them $2 million if I was only expecting 7%, but if I wanted 8%, I would give them less than $2 million. I'm not going to do the math and calculate that out, but if you present value the principal payment and the annuity payments back at 8%, you will get something less than $2 million. And that's because I'm demanding a I'm demanding an 8% return, even though the bond's only paying 7. Now, alternatively, let's say I looked at the company and said, you know what, I'd buy this and accept a 6% return. That's less than the 7% that's being paid. So I would be willing to pay more than the $2 million for this series of cash flows. I would pay a premium on top of the face value of the bond for this series of cash flows. So that's what's going to generate a premium. If the interest rate that I demand, or the market interest rate, is less than the stated rate on the bond, I will pay a premium for this bond, for this series of cash flows. The premium in relation to the face amount of the bond, which in this case was $2 million. So my premium or discount as a company, let's say I sell a bond at a discount, which means the market is demanding a rate that is higher than what the bond is paying out. So I recorded a bond discount at the time of issuance. So when I issue the bond, I'm going to debit cash because I sold a bond and received cash. And then I'm going to debit discount on bonds payable for whatever the difference is between cash and the face amount of the bond. And then I'm going to credit bonds payable. So the carrying value of the bond is bonds payable minus, in this case, the discount on bonds payable. That's the carrying amount of the bond. That equals the cash I received. It also equals the amount I am borrowing when I start out. That's how much I'm borrowing. That's how much cash I got. So that's how much money I'm borrowing. And I'm borrowing it at the market rate. I'm not borrowing it at the stated rate of the bond. I am borrowing that money at the market rate. So my interest expense for the first period is going to be the amount that I am borrowing, which is the cash I received, times the rate, or the market rate, of that bond when it was issued. That's my interest expense. In this case, that interest expense is going to be greater than the cash interest paid. So we're going to pay cash. The interest payment is going to go out, just like we talked about. That's the annuity part. That's going to go out. My interest expense is going to be more than what I pay out. Again, because my rate is higher than the rate I'm borrowing the money at is higher than the rate at which I'm paying money out at. So I'm going to have a higher interest expense than the cash paid out. That difference between the interest expense I incur and the amount of cash paid out goes to reducing the bond discount, and that's called amortizing the bond discount. That amount will gradually decrease that bond discount through amortization over the life of the bond, to the point where at the very end there is no more bond discount, or there's no more discount on bonds payable. All that's left is the bond payable. We pay the bond payable, it goes away, cash goes out the door, and we're done with the transaction. So that's how we get rid of that discount in the financial statements. So that wraps up bond accounting. I also walked through an example of expected value, where we calculated, say, the present value given different scenarios and then weighted them by the probability of the scenario occurring. That's something that's being rolled more and more into accounting, instead of just saying, well, what's the most likely outcome and booking to that. So that's usually the alternative. So we're doing more expected value calculations in accounting, especially for footnotes and note disclosures. And then also a deferred annuity, where there's an annuity, but it doesn't actually start paying out for some period of time. So for instance, if I have retirement benefits that I don't have to start paying out for 10 more years, and then I have to start paying them out, that's deferred. I have an annuity that is deferred in time. To calculate that, we just took we calculated basically what would be the total annuity, and then we subtracted out like the next period, the period of time when we aren't actually doing anything with that annuity, and that gives us just the deferred annuity piece. So that pretty much wraps up everything from the time value of money calculation stuff, as well as the other two chapters, income statement, balance sheet. At this point, you should be comfortable preparing all of the full face of the financial statements. That means the income statement, the statement of equity, the balance sheet, the cash flow statement, and then also being able to do the time value of money calculations in terms of present, future value of single sums, of annuities, primarily ordinary annuities, and then doing the accounting for bond transactions. So that wraps up the review. Good luck and God bless.